Among the taxes scheduled to go up on New Year's Day, if there is no solution to the fiscal cliff, are taxes on dividends and capital gains. 403 of the 500 companies in the S&P 500 stock index now pay investors to hold on to their shares. That's the highest number since 1999. These companies paid shareholders a record $34 billion in cash in August alone. Now, the threat of higher taxes on investments has hit stocks of traditional dividend payers, such as utility stocks. This exchange-traded fund follows the utility sector, and it's fallen to its lowest price in 11 months. We spoke recently with the CEO of utility company NextEra Energy, Lou Hay, about the threat of higher taxes on dividends.
It's going to affect investors first and foremost, because the rate on dividends is scheduled to go from 15% to 43.8%.
That's the highest end possible.
That's on the highest end possible, but that's almost a tripling of the tax rate. So the after-tax proceeds to investors will go way down. But if that was it, maybe that would be okay, but it's even more than that, because with a higher tax rate on dividends and lack of parity between the rate on dividends and capital gains, a lot of investors will switch out of dividend-paying stock, so they'll sell. That'll depress prices, so investors will, and it's not just people who invest directly in stocks, it's anybody who invests in a 401k, a pension plan, life insurance even, they're going to see the value of their investments go down.
Is your main critique, Lou, the difference between the scheduled tax increases on dividends and those scheduled to take place on capital gains?
The thing that I'm pushing for, and frankly our whole industry and most industries that pay large dividends are pushing for, is that parity between capital gains and dividends. We don't want another situation where the government is picking winners and losers, if you will, and with a differential rate, people will switch from those dividend-paying stocks to other more tax-favored stocks or investments, whether it be stocks that pay capital gains or other kinds of investments.
If you go back prior to 2003, when the current tax structure for dividends and capital gains was put into place, companies still paid dividends, shareholders still sought out dividends, and dividend stocks still fluctuated, generally speaking, with the rest of the market.
The biggest difference is, since that point in time, the amount of dividends being paid by companies has more than doubled. So with a lower tax rate on dividends, companies have stepped up the dividends that they pay at a rate higher than really their earnings growth has been, including companies that didn't pay dividends in the past. Even Apple now pays a dividend. And dividends also show stability to investors, and I think most investors actually like the dividends. So and we also saw stock prices adjust when rates went down, and that was good for customers. But a high tax rate on dividends is a high tax rate on investments. And there's a general rule of thumb in economics. If you want more of something, you reduce taxes on it. If you want less of something, you tax it more. And in our economy right now, with a lot of money sitting idle on the sidelines and a lot of people unemployed, the last thing we want to do is increase taxes on investments, which will therefore result in less investments and less jobs.